Hi, I'm Isaac Satin, Director of Client Communications for IBISWorld. I'm excited to be joined by James Mulvihill, who's IBISWorld's Senior Vice President in the Industry Research Division. James has worked closely with our largest commercial banking clients over the last decade and has an intricate knowledge of the use case for credit professionals. He's been gracious enough to take some time and share with us a bit about how our clients are using industry information currently and a few advanced ways to use IBISWorld information specifically for those in the credit department. James, let me throw it over to you to get us started. Thanks so much for joining us today.
Thanks, Isaac. I greatly appreciate it. I'm going to go ahead and share my screen here. And to begin, as a credit professional, the first page that you're going to visit is My IBISWorld for Banking. This is the homepage for everything that IBISWorld produces for our banking clients. You can see on my screen that there are a variety of different bookmarks that are available, and one of those industry reports we're going to jump into right away. We can also select underwriting. If I do that, that'll bring us to that section first. So when I click on paint stores in the US, what's going to come up is the industry report under the industry at a glance for banking and under the underwriting view. We begin our underwriting view with our risk rating snapshot. This is one of the key elements that differentiates IBISWorld amongst any other provider of information. Our risk rating system is built on a 3 different tier system. And what we'll do is we can see here we have a score of 6.33 on a 0 to 9 scale. 9 is the highest potential risk. As a credit professional, we want to identify different areas across every industry that are pain points for those industries. So to be able to better understand what's happening within this industry, we can read some of the context down below, which will compare this industry to the sector that it belongs in, as well as the sector to the overall economy. However, I want to identify what's happening with this particular industry. This is paint stores in the US. And to do so, I'm going to look at our US risk rating report for this industry. For every single industry that IBISWorld covers, all of our US NAICS industry reports, as well as our specialized industry reports, we produce these risk rating reports and update them on a monthly basis. We'll get into the importance of updating these industry reports, these risk rating reports on a monthly basis in just a few moments. Here we can look at the different components to the risk score. Again, on a 1 to 9 scale, 9 being the highest potential risk, we can see where the difficulty within this industry lies. We will always look at the structure, the growth, and the sensitivity risk of every industry. We also put weightings on each one of these categories, with structure representing 25%, growth representing 25%, and the most important factor, and the reason why we update these reports on a monthly basis, are those key sensitivities, which are weighted at 50% of the risk rating score. Now we can see what type of category, what type of level these components fall into, with, for this industry, currently structure being medium, growth risk being medium high, and the sensitivity risk being very high. Now we need to identify what areas of this industry are creating those pain points to make sure that the business that we're working with has different risk mitigants in place to be able to counteract some of these negative pressures that are impacting the industry. So here we can take a look at the areas across the industry that are creating those pain points. So when it comes to the structure of the industry, we always look at the same 7 components, beginning with barriers to entry, competition, the level of trade with exports and imports, the level of assistance from the government, the life cycle stage, and the revenue volatility of the industry. So for pain points for this industry in particular, I would look at barriers to entry and competition. Why would I do that? Well, I can see here that we have the highest potential risk score, a 9 for those different categories. So when barriers to entry are low, that makes it easy for competition to move into the same marketplace, into the same neighborhood, and steal market share. When competition's high, that creates additional pressure for the industry. Now, if I wanted to find out the exact reasons why barriers to entry are low for this industry, creating that difficult environment, or why competition is high for this industry, again, creating that difficult environment, I could simply scroll down and review the information to show us why barriers to entry for the industry are low. To find out why competition in the industry is high, both from the aspect of internal competition, which is one paint store in this example, versus another paint store within the same industry, or looking at their external competition. In this example, would be one paint store versus some of those home improvement stores, your Home Depots and Lowe's of the world that they're competing against.
James, let me just interrupt real quickly. I've always thought of the risk scores at the top almost as warning signs, right? Flashing, blinking lights that if it's 7 or above, it's your cheat sheet of areas that you need to go to and take a look at and become more familiar with. So it really cuts out some of that time to immediately understand what are some of these structural components of the makeup of the industry that I need to take a look at and be aware of. Even if I don't act on it, I need to have that knowledge base because it's something that's influencing it. So I love to just look at it as, 7 or above, you need to go to those chapters and read those sections of why is it that score.
Yeah, absolutely. And this doesn't mean that you're not going to provide funding or lending to that particular business. It just means that you need to put some extra scrutiny behind it, identify what that business is doing to be able to fend off some of the competition, to be able to fend off new entrants into their market. Mm-hmm. And a lot of that goes back to the key success factors of each and every industry, which IBISWorld does a really great job of putting into our reporting as well. So just know that we're going to help you in terms of understanding those pain points that these businesses are facing to be able to then assess each individual business in your credit write-ups. So absolutely, that's a great point, Isaac. Next, we assess the growth risk of the industry, and we put some additional weighting on the forecast growth of the industry. The importance behind this is we want to look forward-looking. We're providing funding. We need to assess the business for what's going to happen in the short term over the next year or so. So that's where, in this example, we're looking at the forecast growth for 2022 to 2023, and we're looking at some negative growth for this industry. So that means that this industry is going to retract a little bit in terms of their revenue. Why would that happen? Why is that the case? Well, we can scroll down and find the answers to those questions down below by looking at our growth risk analysis. What's happened recently? Perhaps this industry had some great recovery during COVID and now is facing a bit of a retraction. Perhaps this industry is facing some other economic pressures in the immediate future. Being able to understand that information, we make it really digestible for you here. Again, this will also help provide some of that guidance when you're reviewing that business, their business plan, and making sure that their future growth rates for that particular business are in line with what's happening within the industry. The final section of risk is looking at the sensitivity risk. This is really the most important section of our risk rating reports, which is why it's weighted at 50%. Again, we want to look where those numbers, as Isaac had mentioned earlier, are higher than a 7, because these are going to be the pain points that the industry is facing that are outside of their control. But we want to make sure that there are certain things that are happening within the industry or happening within their business to counteract some of these potential pressures. So IBISWorld assesses a large number of different business environments as well as supply chain issues that are happening within each and every one of our industries. In this example, you'll find a variety of different business environments like housing starts, private spending on home improvements. You'll also find a supply chain issue in terms of demand from painters being represented within this report. Currently, when we're looking at housing starts, that's going to be a big pain point for the industry. So the projections for housing starts at this point in time are that there are going to be a decrease in terms of the number of new housing starts, and that's creating pressure on paint stores. New housing requires paint for the walls, and contractors and painters are going to go to paint stores to procure that product. And when there are fewer houses being created in the United States, that's creating some additional pressure for this industry. So there's less demand for the services as a result of the housing start change. Same thing goes for a variety of these different factors: private spending on home improvements, per capita disposable income. So the reason why we update our risk rating reports on a monthly basis is due to the fact that these metrics, these facts come out at a variety of different times, and we need to be able to shock our system with that new data. So as new housing start data comes out, or as new per capita disposable income data comes out, we're able to then shock our entire industry report collection and show the impacts of these different factors, these different business environments on each and every one of the industries. But also know that some of these factors might be positive for one industry and negative for another industry. So for example, with commodity prices on different mining operations, that might be a positive thing if prices are going up. But on transportation, that might be a negative business environment for those industries.
Perfect. Well, that's a great overview of the risk ratings. Reminder to everyone, if you don't have access to the risk ratings, please reach out to your client relationship manager. We'd be happy to set up a trial period for you, get you some reports to look at for industries that you're currently underwriting, to really see the difference that it can make in your process. What else do you have for us, James? We're excited to jump to the next part here, some advanced usage.
Yeah, absolutely. Thanks, Isaac. I appreciate that. So I'm going to scroll down and look at some of our financial ratios that we provide. So within the My IBISWorld for Banking site, we take some of those common ratios that are going to be utilized by credit analysts and present them at the national scale right here for you. Now, if we wanted to dig in deeper and learn some greater granularity about comparing similar size businesses, we have the ability to do that by simply clicking on Learn More. And within here, you'll be able to actually assess the particular business size that you're working with based on asset size in a variety of different categories. We cover 10 different categories. So let's say we're working with kind of a middle market type business, $25 to $50 million. All this underlying data for the ratios are going to be updated down below. Now, one of the key attributes here is that we're using IRS data, which is the largest sample size available, to be able to create a really comprehensive list of different ratios for these industries, as well as being able to have that granularity to match up similar size businesses. We're going to cover all those key ratios that you're familiar with to be able to benchmark your client versus the industry. If you wanted to create a cash conversion cycle ratio, you have all of those ratios available here, your days inventory, your days payable. We also provide the debt service coverage ratio, again, one of those key factors when we're analyzing a business comparative to the industry.
I know James and myself have both been with IBISWorld for over a decade, and when we added in those ratios, over 40 of them for all of our industries and all of the different asset size. I mean, we're talking millions of data points at that point. Our clients were just thrilled with it because it'd been something that had been asked about for so long. So we really encourage people making sure they go and find that towards the end of the report there in that key statistics chapter.
Absolutely. And one of the other key factors is, as a credit analyst, you're going to be looking at a variety of different risk factors affecting different industries. And if you're coming across those same key external drivers for many different industries, it's important to be able to discuss that with your leadership and let them know that, hey, a lot of the concentration within our portfolio might be impacted by similar key business environments that might be leading the bank into a direction of, hey, we need to place some limits on some of these industries based on the correlation and based on similar key external drivers. So always keep that in mind as you're looking at different industries and looking at different businesses, that they are going to be impacted by these key external drivers. And if you wanted to review any of the information, we can simply click on these to be able to review other industries that are impacted by those similar drivers.
Sure. So, James, we've done a great job of showing some of the more intricate areas of our content. We have a lot of clients who are obviously regional banks, banks that operate in just a few number of states or even counties. Is there anything that IBISWorld offers that can help in trying to understand smaller businesses as opposed to just the large ones?
Yeah, absolutely, Isaac. That's a great question. So we have a product called segment benchmarking. And for this, I'm actually going to switch over to a different industry report. Everyone's familiar with Coke and Pepsi, right? So Coke and Pepsi dominate the soda production industry. They, in fact, amongst some of the other large players, represent 89% of total revenue is from those employers that have over 500 employees. They represent, on average, $751 million in revenue. So really a highly concentrated industry amongst large players. But as a bank, you might be working with a small or medium-sized player or regional player within this same industry. And we want to identify what's happening within their business. Perhaps it's a growing segment size that we want to grow with that business. The goal of our relationships with our clients as a bank is to latch on to those businesses that are growing so we can grow with them and grow our engagements, grow our loans, grow our credit lines with them. So for example, I'm going to look at those businesses that have between 20 and 99 employees that generate an average revenue of $22.1 million. And in this category, we can actually look at their most recent growth rates. Really important to look at how they fared perhaps during COVID, how they fared during other times in the economy. And we can see there are a few businesses across the United States within this category, only 66, but that doesn't mean that they're not a bankable industry.
Mm-hmm.
We can also look at some of the SWOT analysis impacting the industry, what strengths, weaknesses, opportunities, and threats comparative to other groupings across the industry, other sizing of businesses across the industry. We can look at different entry and exit rates amongst businesses within this category. And again, how do they compare to other size businesses within the same industry? The part that I really like to look at are the expansion and contraction rates amongst businesses. And in this example, we can see that 15.8% of businesses are within that expansionary size, expansionary category for this particular industry, for this particular size of the 20 to 99 employees. So again, this might be a strong area if we're working with a business that we might not have previously identified because we're worried about the Cokes and the Pepsis of the world with their dominance. Well, that regional player or that local player is actually growing perhaps at a quicker rate, and we want to make them a part of our banking partnerships. So again, we have the ability to look at a variety of different sizes across multiple industries. Really important when we're looking at those industries that are, again, dominated by large players.
Awesome. And again, this is the segment benchmarking addition to our collection. This came out in 2022. So if it's something you haven't seen previously, again, just reach out to us either on the website or to your client relationship manager. We'd be happy to set up some trial access and give you a look at it so you can use it again, in real time. And it's a great addition to the platform. Again, when you talk about data points of just being able to slice our data even further to meet your needs, I think it's just an excellent addition there. So I think we've gone through some really good things. The last thing I'm hoping you can share with us, James, and we did talk about, is this tool too advanced to share with everyone? But you know what? This is an advanced webinar, so we got to go into it. Our early warning system tool, which is really interesting, especially in times like these where there's a lot of volatility and you're looking to compare point in time and how things are. So why don't you go into the early warning system for us a little bit? Again, this is an additional tool that's available for all of our banking subscribers. So if you're interested, again, reach out.
Great. Thanks, Isaac. So this tool is available under Expert Tools, or if you go in the My IBISWorld for Banking, the credit risk at a glance view, you have the ability to click on Learn More right at the top. That will actually bring you into this early warning system. So as we're updating our risk rating reports on a monthly basis, we're also updating the early warning system. What this does is this looks at all of our NAICS industry reports. So there's 701 industry reports that we cover for our NAICS industries. And what we do is we look at the most kind of peaceful time and peaceful economic time, which was back in September 2005. So it was pre the global financial crisis. It was absolutely pre-COVID. It was pre the kind of COVID boom that we found immediately after the impacts of lockdowns and a variety of different factors that kind of withdrew some of the strength of the economy, and then we had that immediate boom. But what this does is look at the different factors that are impacting looks at the different industries that are either going to be increasing or decreasing in terms of their risk rating level. And currently, there are a lot of industries. There are 311 industries that are changing risk category, meaning that they're moving from low to medium or medium to high or high to very high. Significant number of industries that are increasing in terms of their risk score at the current point in time. And what we do is we actually give you an additional year of risk down below. But for today, we're going to look at the early warning system 2023. Which is the most current risk rating score. And here we can see total risk score for 2023. These are sorted by the NAICS code. So this is why you're going to find all the agricultural reports at the top, which begin with 1-1. Now, if we wanted to look at different directions of risk, we can sort it by those industries that are increasing, steady, or decreasing in terms of their direction of risk. Again, a large portion of this is based on the sensitivities. 50% of that risk score is based on sensitivity risk score, but the other 25 are based on the structure and the growth of the industry. Now, one area that I like to focus in on, especially in today's day, is as a bank, we have a history with a variety of different industries and with a variety of different businesses. But we want to identify what was the most difficult time for the industry And if we wanted to look at those industries that are facing their most difficult time in the upcoming year in 2023, so this is more difficult than COVID, this is more difficult than the global financial crisis, I can sort this list and look at these different industries that are going to be facing those additional challenges. So again, if I wanted to look at any of those manufacturing industries or the retail industries in the economy or healthcare industries in the economy, I have the ability to, again, sort this list and then be able to understand, hey, we're facing some hardships that we have not faced within this industry in a very long time. And what is that business doing? So this is essentially the red flag for these industries to say we need to do extra scrutiny on these industries, and whether it be from a portfolio level, looking across the entire portfolio, or an individual loan basis and saying, hey, this is going to be facing some really difficult challenges in the immediate future. What is this business doing to really make sure that they're going to not only survive, but thrive during different economic times? And again, we have the ability to jump into that 2024 data to be able to look at the direction of risk for the additional year, as well as look at that 2024 risk score. And this is going to be based on all those changes to sensitivities that are forecast for the additional year period.
Awesome. Yeah. I mean, the power behind this tool to, make those strategic decisions of, these are simply industries we can't lend to in the current environment, or we'll lend to them, but we need to really talk about some advantageous terms and rates and what that means and how many of these types of loans we want to take on. So I think that's fantastic. James, this has been great. Anything else that you wanted to share with us today?
Yeah, there's one more thing I wanted to share, which is also a relatively new solution that IBISWorld offers, which is our state and local information. I think there's two different factors from a credit standpoint that are really impactful for this. Number one is your local economy. And we know that there are certain industries that are concentrated in certain areas of the country, that there's larger population centers. And you might have a very similar business within your neighborhood or within your county or within your state that you want to be able to identify, is that industry growing at a certain rate? What factors are impacting that industry locally? The other area that this local information is super helpful for is being able to assess different industries. Perhaps you're working on loan syndications in an area that's not within your bank's footprint and you're participating in a particular loan, and you want to identify whether or not that industry is growing within that other area. You may have had success locally within that industry, but there's another state that industry is suffering some additional challenges due to a variety of different factors. So this state and local information is found in a couple of different areas. I'll focus today on in the actual individual industry itself. So for example, in paint stores in the US, when I click on geographic breakdown, we can identify the sizing of the industry by different states across the economy. So California having the most number of establishments for paint stores and revenue makes sense due to the population centers. However, we can see the fastest growing is going to be in North Dakota. So if I'm a bank in North Dakota, this is an area that I might want to focus in on, but also from a credit standpoint, show, hey, this is an industry that's growing in our neighborhood quicker than the national averages. And we give you all that state data down below as well. So, for example, state data for paint stores in the US by the number of individual operating locations with establishments, the revenue growth, employment growth, wages. And if we wanted to zero in on one particular state, I'll select my state, the great state of Texas, down here, being able to jump into an industry report that is specific to the state is also super important. Being able to look at those different factors that are impacting the industry. And here we can see establishment growth within the state of Texas, revenue growth within the state of Texas, both a recent over the last 5 years compound annual growth rate, as well as a forecast compound annual growth rate provided, and then comparisons to the US. So for example, here we can see that in Texas, where there's a ton more of population growth, we can see that the industry is projected to grow by 1.3%, where annual growth over the next 5 years for paint stores is only 0.2%. So if we're participating in a loan or if we're located in Texas, paint stores is going to be a more stable industry for us to work with. We can also give you the current performance and outlook locally for the industry. And then if I scroll down a little bit further, we can actually select the different counties to look at their growth rates and see how that industry is really growing by individual counties. So from a credit standpoint,
this to me is just the coolest part. I mean, it's just incredible to have this granularity of data at this point, and just getting so market and region specific.
Absolutely. Yeah. This has been a huge help for our credit analysts that are utilizing our information, that previously have told us, hey, we're looking for local information. We need local information. This is really providing them with a great answer for that.
Yep. So just to review, I know we went over a lot of our newer product offerings that we have today, and some old with the risk ratings. But if any of these are of interest and you don't currently subscribe, the risk ratings, the cost structure or the cost segmentation benchmarks, the early warning system, and now the state industry reports, again, all available to our clients. So reach out. We can get you set up with that. Well, listen, James, thank you so much for today. I think this was really helpful. Make sure that you go back and watch this again, as James covered a lot of different areas, but, really grateful for your help today and appreciate it.
Thanks, Isaac. I appreciate your time.